Welcome back to Faultline Finance. Stop waiting for a real estate crash that is mathematically impossible within the current monetary framework. The mainstream financial media is currently pointing you toward a nominal illusion, encouraging you to measure your life's work with a unit of account that stretches, distorts, and ultimately vanishes. Today, we are discarding the elastic ruler. We are looking at the raw atomic reality of element 47. Right now, a median American home costs 5,400 ounces of silver, but the underlying geopolitical and macroeconomic architecture is not just bending, it is buckling. The target destination for this specific cycle is 2,200 ounces. The distance between 5,400 and 2,200 is not a speculative theory or a hopeful prediction. It is the cold, calculated output of a mathematical framework that has been operating quietly since the year 2000. Today, we decode the structural breakdown of the paper markets, the institutional calendar manipulating the next few weeks, and exactly why the window to acquire physical metal before the transition from Jerome Powell to Kevin Walsh is rapidly collapsing. This is not about picking sides in a political theater. This is about objective, sovereign wealth preservation. You have been told that the recession is coming, but I am here to show you that the recession is already here. Home prices have been falling for 3 consecutive years from their peak of $442,000. That does not happen in a healthy economy. We are in a structural contraction that the government refuses to name. And silver is the only asset currently priced to consume the coming volatility. If you are still counting your wealth in dollars, you are playing a game designed to ensure you never cross the finish line. We are going to change that right now. To understand why 2,200 ounces is the inevitable waypoint, we must first dismantle the lie of nominal pricing. In the year 2000, at the absolute zenith of the paper era, a median American home cost nearly 600 ounces of gold and 36,000 ounces of silver. That was the era of peak dollar delusion, where silver was treated as an industrial afterthought. By the year 2011, following the global financial crisis, that same home cost only 119 ounces of gold and 4,600 ounces of silver. The metals had consumed nearly 90% of the home's value in real terms. Today, we sit at 86 ounces of gold and 5,400 ounces of silver for that same median home. The direction of travel is unmistakable. But here's the critical psychological trap that keeps the middle class in debt slavery. You are waiting for a 50% nominal crash in home prices. I need you to listen closely. This belief is structurally incompatible with the current environment. You cannot have a Federal Reserve expanding its balance sheet for 9 consecutive weeks. While the inflation reading is hitting 12-month highs and simultaneously expect a 50% collapse in the largest domestic hard asset class, the two outcomes cannot coexist in the same mathematical universe. When a currency is being debased, hard assets do not collapse in dollar terms. They hold their ground while the dollar melts around them. The government will not let home prices fall 50%. Instead, they will change the mortgage structure. They will extend the amortization period to 40 or 50 years. They will cut interest rates until the monthly payment is manageable on a subsidized note. That is the playbook. Therefore, if you wait for the dollar price to drop, you will be waiting while home prices sit stubbornly at $400,000, and silver moves from $75 to $175. You will have missed the crash because you were measuring in the wrong unit. The real crash is happening right now in ounce-denominated terms, and only the sovereign-minded investor can see it. Context is everything in this space. The precious metal market is currently being managed by a narrative weaponization program. Look at what happened 4 weeks ago. Every major financial outlet was publishing breathless articles declaring that the silver and gold bull market was finished. They pointed to the Turkish central bank, claiming they were selling their reserves and signaling an exit for all emerging market buyers. Retail investors panicked. They sold their positions at the exact moment the media told them the smart money was leaving. But let us look at the actual data that the mainstream press buried. In the last 2 weeks, Turkey has not only stopped selling, but they have reversed course entirely, purchasing approximately 36 metric tons of gold. That is 1.2 million troy ounces bought quietly, without a single headline, as they closed out their United States dollar swap positions. Why would they do this? Because they understand that the dollar-denominated narrative is a management tool for the masses, while physical accumulation is the strategy for sovereigns. This is a fundamental lesson in how financial narratives are constructed to create selling pressure at moments of maximum institutional accumulation. While the media was telling you silver was a relic, the Federal Reserve was expanding its balance sheet for 9 straight weeks. They are injecting liquidity into a system where oil is up more than 60% on the year. This creates a textbook bullish constellation for hard assets. The tension you feel between the dead bull market headlines and the reality of $75 silver exists for a reason. It is the final setup. It is the compression before the expansion. The institutions are refilling their reserves because they know the institutional calendar for the next 90 days is a countdown to a massive currency repricing. Now, let us get into the specific mechanics of the next 30 days because this is where the abstract becomes actionable. The path from $75 to $175 is not a straight line. It is a series of engineered pullbacks. We are currently inside a window that has a very short expiration date. The Federal Reserve meets in 3 days on Wednesday, April 29th. This is likely Jerome Powell's final meeting as chairman, and the conditions are politically hostile. The market is pricing in no rate change. But the meeting is not about the rate, it is about the speech. Powell is leaving under a cloud of high inflation and adversarial relations. If he chooses to emphasize inflationary risks, the gullible paper markets will interpret this as a bearish signal for metals. This could trigger a sharp, short-term pullback, potentially breaking silver below $70. This is the gift you have been waiting for. The technical floor is the 200-day moving average, which is currently rising towards $64, aligning with the February structural low. The convergence of these markers creates a massive support zone. This window, from late May to early June, is the final accumulation point. Why? Because the incoming chairman, Kevin Walsh, is already publicly committed to the rate-cutting cycle. The script is already written. The rate cuts arrive in July, real rates fall, and the capital on the sidelines will flow into silver at an immense velocity. You have until the July pivot to build your ounce count. After that, the door slams shut. Let us run the final numbers so you can visualize the endgame. At my next major price target of $175 per ounce for silver, we must look at what that buys in the real world. If home prices remain roughly where they are, between $390,000 and $450,000, the math is undeniable. A median American home will cost approximately 2,200 ounces of silver. That is a reduction of 60% in the silver-denominated cost of real estate from where we sit today. Think about the implications of that shift. You do not need the housing market to collapse in dollar terms to win. You do not need a banking failure or a government bailout. You simply need silver to reach its next confirmed target based on the macro backdrop, while housing remains stagnant in nominal terms. That is the trade. That is the sovereign path to home ownership without a 30-year mortgage or the burden of bank interest. But it goes deeper. At the cycle blow-off top, where my targets for silver move above $200 and gold exceeds $10,000, the numbers become even more striking. The median home falls to approximately 1,900 ounces of silver. At today's prices, that represents a dollar value of only $142,000. You cannot buy a house for $142,000 today, but you will be able to buy it for 1,900 ounces of silver tomorrow. The families who understand this distinction, who are counting in ounces right now while everyone else is distracted by the nominal price of eggs and gasoline, are the ones who will emerge from this recession as the new landowning class. This is not a theory. It is the historical pattern of every currency reset for the last 5,000 years. We are moving into a decade where the winning trade is to own the things that no policy decision can conjure into existence. Central banks can print trillions of dollars, they can print treasury bonds, they can print digital entries in a brokerage database. But they cannot print an acre of fertile farmland, and they cannot print a physical heavy ounce of silver. When you hold physical silver, you are holding element 47. You are holding 5,000 years of monetary history in the palm of your hand. It has survived every empire collapse and every fiat failure in recorded history. Silver is the ultimate survivor of economic storms. Right now, at $75 per ounce, silver is offering more asymmetric upside than any other physical asset on Earth. But the window is closing in weeks, not years. The May and June floor at $64 is likely the last rational price you'll see. Soon, retail dealers will start implementing wait lists, and the mainstream media will run its first bullish silver cover story in 40 years. By then, the opportunity for life-changing accumulation will be over. You must position yourself before the herd arrives. If this framework is useful to you, hit the like button if you are ready to stop measuring your life in rubber bands. Start measuring it in atomic weight. Subscribe because the Wednesday Fed decision and inflation data are going to move these markets aggressively. We will be here to break them down in real time. This is the strategy. Count your wealth in ounces. The window closes soon. The time to act is now. Prepare your portfolio for the coming shift. I will see you in the next one.